It's easy to teach engineers finance. It's hard to teach finance guys how to code. I started my career back in 2014. All through college, I was like into stock picking and finance and trading options, etc.
You don't want your portfolio to go like this. You want it to be as smooth as possible.
So if you think of someone like a Buffett, right? I don't think so. He's running anything less than a quant model. As an investor, you're never going to have as much information as the promoter. You can't get into his head, right?
Do you think over a period of time, because the world is changing crazy right now, do you think we should have a diversification across India, or should we still just be in India? So Rishabh, first of all, thanks a lot for coming on this podcast. So basically, I love talking to people who have a lot of knowledge in the world of fund management, right? And today what we're going to do is we're going to see if we can get a lot of knowledge from you, your experience, and what do you think about the markets. And I also know that you operate a lot in the quant space. So I want us to like demystify some of the things in quant, because a lot of people keep it very, closed door and hidden. So just some idea on what it is, right? So first, I want to understand your journey to how you created your own PMS.
Thanks, Shashank. Thanks for having me. I mean, we've been watching you since a while, so happy to be here. Starting with the journey, right? I started my career back in 2014, and I started as a research analyst. Prior to that, I mean, during college, I did a BCom in Mumbai itself. So I'm born and brought up over here in Bombay, and all through college, I was like into stock picking and finance and trading options, etc. All sort of speculation also. And I think that's the life cycle of every investor, right?
Yeah.
Like, I don't think so. You don't try your hands on everything. So 2014, I took up a role as a research analyst in another PMS, and 14 to 16, almost 2 years, I worked as a research analyst. Out there, I was doing like traditional equity investing, wherein I was looking at businesses, going to the factory, understanding, from the management. I would say I was a novice, like really immature back then. As a 21-year-old, you think that you know everything, but you soon realize that you don't know much.
That's very good exposure for a 21
Yeah, but great. Like, it was like, I think, helped me in terms of building my foundation, understanding finance, understanding like how, why stocks end up doing well. Ultimately earnings matters the most. How the promoter behaves, and how, like, what his pedigree is, how he's contributing to the growth of the business. So that was like a traditional equity research role. Post that, thought process was that I wanted to do something by myself. I didn't know what I wanted to do. I always wanted to do something by myself. So my partner Kavan and I got together late 2016, and we said that, why don't we manage some of the money that we have of our own? And we started, we went back into trading, and we were trading all sorts of instruments back then. The only thing that we sort of, I think, did correctly was that we ended up doing everything systematically. We were, always, there was no subjectivity involved in any of the trading that we did. So even if we were, take a day or 2 day trade, we wouldn't, subjectively or manually place an order. We would try to design a system around it, and then we would, go about doing that. So that's the beginning part of the journey, wherein that's how I got into systematic trading, I would say. Not yet touched quant. Then I realized that, okay, fine, if you have to get deeper into this, having that skill to code is really important.
Correct.
So because I had done a BCom, Kavan was also from like a BMS background. We said that, okay, fine, let's go back and, let's learn how to code. We started on this platform called Ami Broker, and that's where we started, designing strategies, backtesting. We were new to these things back then, right? So almost like two years, 2016 to 18, we ended up spending, close to like 12, 13 hours a day, just like coding and backtesting hundreds of different strategies. And during the journey, we ended up making some, money. It's not like, I think the one thing that, that I've seen in the last 10 years is that every time we've had any sort of subjectivity, we've not done well. But, any objective system we've done, even though it's been an average performance, we've ended up being positive.
Yeah.
So 16 to 18 was great. That's when we sort of started building the foundation. 18, we started gathering a team, realized that, okay, fine, this can be much bigger than what we are doing right now, and having the right team in place was really important. So, up until 2024, we sort of, scaled up our own book. Purely systematic, everything is automated. Even today, if you come to office, there's no CNBC, there's no television. We're not looking at, speaking to other guys and asking them, oh, what do you think of this stock? If we think of some subjective idea, we figure out a way to go and backtest it. So, fast forwarding to 2024, that's when we realized, okay, fine, we can start managing outside funds also. And that's when we formed the Code PMS in 2024. We are running 4 different strategies under the PMS. We are a 30 people team today. 32 people team, and I think the team is diversified between guys who know finance and guys who know how to develop, learn all sorts of coding that's needed to decode data. I think the one thing that we've realized is that it's easy to teach engineers finance. It's hard to teach finance guys how to code. So we end up also having a lot of engineers on our team because they could think in that quant lens. So I think the team is a big contributor to our success today. We're managing about 350-400 crores in the PMS today. 30-35% of that is our own AUM, so that's partner contribution that we've grown over the years. And I think a lot of confidence has come because what we do for ourselves is what we do for outside investors today. So I don't think if I'm going back home, I'm yet thinking about where the markets are going to be 1 year down the line, because my money is on the line, right? It's not like I've deployed my money in a fixed deposit and I'm putting up investor money into the fund. So the thought process is always that you want to compound capital at great rates. Within the PMS, we are running 4 different strategies. We can come to that point.
I wanted to ask on that because I went through your website and you have the PPT, so I went through all of that. In that you have the first one, which was the all-weather portfolio, which talks about an ETF-based PMS portfolio.
Right.
And that I saw the 1 year, 3 year, 6 year, 12 month. It looked very impressive because it beat the index on an alpha perspective very well. Now, first question is how? Because this year has not been the greatest year for a lot of people, right? Let's say even the last 12 months has not been the greatest year. What is your thought process behind creating an all-weather portfolio, which is mainly built for such scenarios? But how did you devise this, and what is that? I don't know, what is that uniqueness of that?
So, if you look at the name all-weather, right? I follow this fund manager, Ray Dalio, and he's a legendary fund manager. He's written a couple of books recently on macro events. I think so. If you study someone like him, and then you study there are lots of successful fund managers in India or investors in India. I think his method of investing. So there are multiple ways to make money in the market. There's no one way, right?
Correct.
You could be an ace stock picker like any of the investors in India, or you could be a good asset allocator. And I think that's where all-weather comes into the picture, right? So Ray Dalio, also runs an all-weather fund, and there's a YouTube video of him drawing a graph and saying that if you can have 15 uncorrelated assets, right? And what he says about uncorrelated assets is that all of these, make money at the end of 10 years. All of them will be up 12%. But they will make money in different time periods. If you can create that portfolio, then you will probably have a very smooth equity curve. Your risk will go down by 80%. And that's where the thought of all-weather came. We don't have 15. We have about 3-4 assets
India,
today.
It's very limited.
It's limited, but the thought process is that okay, fine, let's try to build something, and that's where the idea of all-weather came through. And the thought process between all-weather is that, when you're investing in something like an all-weather portfolio, is that you want a very smooth equity curve. So I think with investing, what also matters, Shashank, is not only the number, that I did 25% per annum at the end of 10 years. What also matters is that what the journey was, right? I don't know if most investors are or have the gut to see the 70-80% drawdown that we saw in 2008, the 40-50% drawdown in 2020, right? Not everyone is like a Warren Buffett, though we aspire to be like him. But if you think about it, right, he's seen his portfolio being down by 60%, 4-5 times. And Ray Dalio keeps questioning this, that, okay, fine, why do you need to see those kind of drawdowns if you want to generate alpha? And that's where asset allocation comes into play. So in all-weather, what we've done is that 40% of the portfolio is gold, 60% is equities. Within equities also, we've tried to sort of, even though there is some amount of correlation, but within equities also the stocks the ETFs that we are holding are have a low correlation. So for example, like a momentum and a low vol ETF or a value ETF. So we are playing with these ETFs. And along with that, we're protecting the equity portfolio using put options. So this portfolio, say the last 1 year has done really well. The top, the third PMS in the country in terms of 1 year performance. Now, the idea with the all-weather, the thought process is very straight, that you want a smooth equity curve. You don't want to see large drawdowns.
So just to explain to people, maybe they won't know what an equity curve is. It's basically in a 10-year journey, you don't want your portfolio to go like this. You want it to be as smooth as possible, which reduces the drawdown as much as
Exactly. Like, maybe to simplify it, I give an example, right? Like if you look at 5-year performance of two funds, say the first fund, the first 4 years, it did 30% per annum. The 5th year, it was down 30%, right? Which is generally the life cycle of most funds.
Correct.
And then you have another fund which has done, 4 years, 25%, 25%, 25%, and the 5th year is flat. Didn't lose money, but it's flat. You will see that the CAGR of the second fund will be significantly higher than the first. Just because of that one down year, it changes your CAGR completely. So the thought process altogether is that you don't want to be bruised in a bad year. You don't want to get hurt emotionally and financially, both.
So not losing money is also making money.
It's a big thing. So there is a chance that you might underperform in extreme bull markets where say Nifty is up 40% in a year, you might be up 25-30%. And I think that's easier to stomach than to be down 30%. Even if everyone's down 30% and you're down, it's going to hurt you financially, right? So that's the thought process. So that, the process where you're not losing big makes your equity curve really smooth, right? Makes your journey to compounding really smooth, makes it makes you sleep at night.
So you basically blended ETFs, obviously rotating it, but you blended ETFs with gold and some put options when the market is bad.
Exactly. So these are the uncorrelated assets that we have been able to sort of devise right now. For us, see, the research is an everyday exercise. If we find that, okay, fine, there's another asset class that can contribute, we are looking at that and trying to make the system a lot better. So what we end up doing is that whenever we think of something, we end up backtesting it. So we take all this data because it's purely system driven, right? It's a completely objective process. So we look at say 20-30 years of data and then we try to see, okay, fine, what happened back in 2008? I think one thing that as an investor where quant really ends up helping us is that even though I've not experienced 2008, I can go back and see that, okay, fine, if I ran something like this, what would happen to me, right? Like most small cap investors don't know what happened in 2008, right? People were down 75%. If you're down 75%, very hard to get back up. You would forget everything. You would stop investing.
The investors would leave you.
Right. You can go out there and speak to veteran investors and they tell you how bad it was. Right. And I don't know if, we'll be able to bear something like that, even though, we speak about long-term investing. So that's the thought process of all weather, right?
And do you do stock picking as well? Because in your earlier days, as you mentioned, you used to look at it in that perspective. So do you do stock picking also?
Yeah, definitely, right? So one part of what we do is asset allocation. So that's where the macro framework and gold and stuff comes into the picture, wherein can we allocate correctly at the right time? And then the second part is stock picking. So it's more like a top-down approach. The second part is that in our third and fourth strategy, out of the 4 strategies we have, the third and fourth strategy, we do pick up, small businesses where we are saying it's a small and a micro cap portfolio. And the third strategy, which is the code growth fund, that's a pure quant approach where we are holding 30 businesses equal weighted. Average market cap would be anywhere around 8 to 10,000 crores. And the fourth one is where, we are looking at really concentrated positions, called future horizon. So we are picking up, 8 to 10 businesses only. Idea is that you want to hold these businesses for 3 to 5 years as they mature from a 2,000 maybe to a 10,000 crore market cap or a 20,000 crore market cap.
That is proper value picking.
That is proper value picking. The thought process out there is that from a quant approach, I think there's one limitation that I face personally is that going in on a concentrated position on smaller businesses becomes very hard because there's not as much data available today, right? The markets are maturing. We are not like the US where even small businesses are reporting monthly numbers, right? In India, that's yet we are maybe a few years away from that. So even quant has been has been maturing because data is more easily available, right? The fact that data is not available also helps you create an edge. So, investors who are investing in small caps and have made a lot of money out there is because there's an information advantage where you're going on ground and figuring out what the business is doing. So there is alpha to that. So from our perspective, from Code's perspective, I think we are trying to find alpha wherever we can find it. We are not, we're not saying, quant is the only way you can make money. There are multiple ways to make money. Let's figure out what suits us the best. So that's how we've devised all these 4 different strategies and we are working around.
So I have a question here. So you have, obviously one side is the quant backtested with a lot of data. You also have the concentrated value picking kind of a model, right? Now, usually, it's very difficult to keep the two at bay because one side of your brain is without backtest, it is playing unknown territory. Whereas the value guys say you don't need to backtest, you need to play on value. Now, I've met a few guys who are also in quant and they say that when you play quant, you have to be a slave to the system. Right? Or if you override it, there are times where you might go haywire, right? So when you play the small cap quant, how does that come into the picture? Do you have fundamental parameters for the quant, or is it based on some other factors? Just to get an idea of it.
I mean, I completely agree with you, right? Like when we were on the initial stages, we were like very big slaves to quant, wherein we would be like, there's nothing better than a quant model.
Yes.
Right, like, and you have to stick to the system. I think there's a lot of merit in sticking to the system, and probably you'll do a lot better by sticking to the system than doing it subjectively. So what we've ended up doing is that starting with the quant 30 stock quant portfolio, that's strictly quant. So we're not overriding the model in any way. The only only part where that we override is, for example, looking at quality checks, or looking at checks whether the business is not a fraud, cash flow checks, and doing on ground checks,
like corporate governance and sanity checks.
Exactly, right? Like things that anything that cannot be put into a model because the data is very erratic. There we'll have to sort of take that data out and look at the numbers. I would say there are two ways of looking at quant. One way is that where you just do pure backtesting. For that, data needs to be very clean, right? Then there's another way of quant, which is what Ray Dalio ends up doing, right? Where he's subjectively studying data. So, for example, like his last book, which is The Changing World Order, he's looked at 500 years of history for macroeconomics, and he's trying to figure out, okay, fine, which country behaved in what way, during a particular crisis, right? And I think that's also a quant method. To put some emphasis on that example, if you look at 2020. 2020, he tweeted that, get your hands on any asset that you can. And, how can someone be so confident? And at his, status, you put out something like that. It's pretty controversial, right? But then he was like, see, for most of you guys, COVID is a new phenomenon, right? But I've studied history, and something like this, like for example, the Spanish flu came in 1915. It's just that it came in a different form. It didn't happen in the form of COVID. So what he mentions is like Mark Twain has this tweet that says that history doesn't repeat itself, it rhymes.
Yes.
And that's what happened with COVID. So back then in 1914 or 15, when it happened, the government ended up printing a lot of money, and all the same characteristics played out that played out in 2020. So that's also quant approach, right? Where you're looking at data, but you're looking at with a little bit of subjectivity or with a subjective lens. So because data is erratic. So I think that's where, we are also moving to that side wherein, okay, fine, we have systems, but if there is a, logical way of improving that system, and then we want to test it out using history, that's when, So the 30 stock portfolio is pure quant. We are looking at pure fundamental factors. We are looking at, high ROC businesses, low debt, earnings momentum, price momentum, and all of these things are put into a factor model. And then we buy the top 30 businesses.
Is it a high churn model because it's small cap?
It's a very low churn model. We end up doing like just one churn a year. Out of the 30 businesses, 10 or 12 businesses go out, 10 or 12 new businesses come in.
Okay, fair enough.
And we've seen success. Like, in the past when we were running the model, personally, we had success with businesses like Tata, Elixir, or like Awari, where, even if I didn't understand the business, it became a part of my model, and we did like a 5-bagger or a 7-bagger out there. So, but the idea with a 30 stock portfolio is that it's all about the aggregate. It's all about sum of the parts. It's not about, I'll get one, multi-bagger that's going to become a 30-40. You might have that, you might not have that, right? You'll have a 60-70% hit ratio. So you'll have 60-70% winners. 30% of this business will lose money. You're not going to have a 100% hit ratio, right? That even Warren Buffett doesn't have something like that. And, but those winners will end up, compensating for everything. And then the fourth strategy is wherein the subjectivity comes in.
Which is the value basket.
Yeah, which is the value basket. Out there, what we've tried to do is I try to quantify all the rules. So if you think of someone like a Buffett, right? I don't think so he's running anything less than a quant model. And why I would say that is, for him, all the rules are already set in his brain.
There's certain basic parameters are set.
Like, for example, like he has a too hard basket. Like, if I don't understand the business, it's going out of here. If I don't understand tech, right? He speaks about tech business where there are guys out there who know this a lot better than me, right? Like say an Intel or a Microsoft. He's saying, even though I missed out on it, I'm not sad about it, right? I'm sad about things that I could have known, I could have learned, and it was in my circle of competence, and then I missed out. For example, like he missed out on a Walmart or an Amazon, and he's like, okay, fine, these are actually not tech businesses, right? They're more retail businesses, and I should have identified them. Yeah. But something like an Intel or a Microsoft, he said that this is way outside of my comfort zone. So he's made mental models, and he's following those models. It's very hard as humans to do what he did.
Yeah,
right. Like it's not that it's great the way he speaks. But what he's doing requires, some level of intelligence. And more than that, if you think of it, If you want to be someone like a Buffett, you know, he's been doing this for the last 75 years. He spent 12 and a half, 13 hours a day just doing that, like really hyper focused, right? I don't think, you know, most people have that capability. And if you have, then I think you can become, you know, you can do what he's done.
Yeah. Yeah. No, that's very difficult. Now, coming to your value side, because now I want to segue into that. Like, because these are small cap companies, right? Obviously, in small cap, they say risk is higher, reward is higher. It's asymmetrical kind of a way. Today, as you said, there are some companies giving half-yearly information, yearly monthly information, quarterly information, and you have some data. Some places you don't have data. So, what are some basic parameters, if you can? And do you also look at some sectors from extrapolating into the future? Like, you know, we see it going here, so we back end it and we look at companies here. So do you do a sector first approach, top down, or do you do a bottom up approach in this?
So I think we do a large part of it is a bottom up approach.
Okay, so find the stock first.
Yeah, find the stock first. We do have views on sectors. For example, like 5 years, 2021 to 24 for us, solar was a big play. But as of now, we're not looking at any of the sectors that way. What we are now trying to get down to is that, okay, fine, can we understand the business? Ultimately, stock return will come from earnings growth. And if there isn't any earnings growth, then there's not going to be return. And as an investor, you have to be able to predict earnings, right? With a certain amount of probability. So the way we try to quantify this is that, say, you know, I look at a business and information is always going to be you're never going to have a 10 on 10 in terms of information, right? So the guy who has a 10 on 10 information is the promoter. That's why he owns the majority of the business, right? So if I run, say, a PMS, the reason I own a majority of the business is because I'm running the business, I control the business, and I know to a certain extent what actions I'm going to take and what my future is going to be. So that's why that's the largest holding I have, right? That's the same thing with any promoter, right? So now, as an outsider, as an investor, you're never going to have as much information as the promoter. You can't get into his head, right? You can have 5 conversations with him, but you're not going to know what action he's going to take. So you have to sort of give a rating as to how much information you have. Based on that, you start position sizing. That, okay, fine, should this be a 2% position size, a 5%, or a 10%? If you look at like a Rakesh Jhunjhunwala, he scaled into his Titan position.
Yes, scaled up.
Right? He scaled up. Like the stock kept moving up. He scaled at double, triple, and even 4 times the price. And I think the thought process with that also is that as you understand the business more and more, as it becomes more systemized, you can keep scaling into that position. So what we've done on that side, on the value picking side, is that we end up owning 10 to 12 businesses. We end up picking up at least, you know, a 10% stake in the business, but 10% of our portfolio. But we scale into that position, right? Our thought process is that as things mature, as we have more understanding, if there's a business that we really understand and it's very, you know, everything is available, then we straight away go with the 10% position size. Otherwise, we, you know, slowly scale into that business.
And do you look at starting valuations?
We look at starting valuations for sure. I think valuations matter a lot. I think the only thing that you can control is your entry. You can't control anything from there on, right? So I think one of the things that we do within the PMS is that, you know, taking a step back. When an investor comes to me, I'm not looking at, like, if an investor tells me I want to invest in your value PMS today, I'll say that I will decide that, okay, fine, is it a good time to invest in small cap businesses or not from a broad macro lens. For example, anyone who came to me back in 2024, we did not do any new allocation in the small cap PMS. 90% of our allocation went to all weather, because across the board, like, so within code, what we end up doing is that we use different quant, macro and micro indicators, try to figure out where the market is placed. So for example, like most of our indicators all through 2024 were telling us that the small and the mid cap space was extremely overvalued. There were valuations like, you know, at 80 times, 90 times earnings, price to book at like 10, 12, 14. So the expected return, the expected earnings growth was too much out of there. There was no margin of safety. If there was any miss in earnings, the stock would, you know, be down by 40-50%.
Correct.
And that's what we ended up seeing, right? And that's why most of allocation was in all weather. And so I think that's where, you know, alpha is generated. I think market timing is extremely important. If you look at the top 10 PMSs, you know, over the last, say, with 1 year performance, right? There are very few who have, say, done north of 15-20% per annum. This year, right? There was one PMS that did, you know, north of 20%, and then we started figuring out, okay, fine, what did they do right? Though we were also number 3 out there, we also made 25-26% in the last 1 year. Gold was a big play for us. But there was another PMS that did extremely well and was 100% invested in equities, right? Without an allocation to gold. So we started questioning, okay, fine, how did they do something like this? And then we figured, okay, these guys were picking value businesses, and banks and NBFCs ended up doing extremely well in the last 1 year, right? And that's where they had allocation. So you'll always find an opportunity. It's not like you won't, but you have to keep learning, right? So if you go back from 2018 to 2025, right? In different time periods, different sort of segments of the market have done well. So 14 to 17, small caps did extremely well.
Yeah.
The index itself from 1st Jan 2014 up until like October 2017 must be run rating at like a 40% CAGR. 18, 19, 20, like small cap was down 50, 60%. And like value businesses, the Nifty itself ended up doing decently well, right? So then 2021, 2, 3, again, like was really average. 2021 was great for momentum. 2022, Nifty did badly. Small caps ended up doing badly. 23, 24, again, the small cap cycle picked up. So ideally, I'm not saying that you can keep switching, but your starting point does matter. Had you started a small cap PMS back in 2018 in Jan, would be very hard to do really well because 3 years was extremely bad. But as a fund manager, that's your skill, right? Like that's where you got to realize that, okay, fine, where do I need to allocate?
So what do you think about today?
So where we are today, right? I think we are in that zone. So the way we divide the market is that either, you want to be really aggressive, there's a neutral territory, or you're very defensive. You can be very aggressive when valuations are really cheap and the entire macro environment is very conducive for growth, right? Then you're in a neutral territory where you can't take a view because it's not like things are very cheap or things are very expensive. And macro environment is a little jittery. And then, you want to be very defensive, which was 2024, wherein, like macro environment was jittery, valuations were through the roof.
Correct.
I think today we are in the neutral territory. And that's where we have any new investors having some amount of allocation to the small cap side, but I would say 20-30% of the portfolio, not completely. To outperform on the small mid cap space, timing matters.
Yeah.
Whatever you say, it's something like, I keep giving this example of Buffett, right? Like today he's sitting on a 40% cash. The fact that you're sitting on cash means that you're timing the market. Even though, he would say that for the general retail investor, he would be like, you should remain invested at all times. Makes sense. But I think if your objective is to generate alpha over the index, then timing will matter.
Correct.
Right.
Correct.
So yeah, I think today we are in the neutral territory. We are not in the very aggressive or in the, back in March, there was a point where Nifty was down 16-18%, small caps were down 30%.
Correct.
That's where like we did a little bit of aggressive buying on the small cap side because we saw that opportunity. I think the drawdown windows also now in India, like the parts where markets are down 10, 15, 20% are reducing because of the mutual fund buying and the kind of liquidity we are seeing in the market. We're not seeing very large, phases where the markets are remaining down for 30%.
So you're saying the upswings are faster?
I think the more than the upswings, we're seeing more time corrections. Like the last 1.5 years, you would name that as a time correction where the markets have not done anything. So it just frustrates, you'll get frustrated as an investor.
Yeah.
Right? You've not lost money, you've not made money, you're just sitting there. And then, people like, Arey, FD mein to banta tha na 7%.
Yeah.
I lost that and my cost of capital is 11% and like all those things come out. Right? So time correction is something that, you have to play out. There's no other way of, working around it. The one way of working around is your entry price, right? So anyone in 2024 who would have looked at the market in detail and not been a part of the euphoria and looked at 5-year returns and 4-year returns and all north of 30% back in 2024.
Yeah.
If you'd have put your head on the table and said, okay, fine, let me look at, is there any value available today? You would not have found any value. You would not have allocated to a small cap space. You would say, fine, maybe I can sit on cash or at least I could move to the large cap. For example, the last 1 year, Nifty is up 12%.
Yeah.
Right? So Nifty actually ended up doing well.
But your portfolio didn't do well.
Yeah. So I think that's the skill of the fund manager, right?
Got it. And how much do you look at macroeconomics? I want to dive a little bit into that. Because you have your quant systems, right? Quant systems are purely based on certain set of rules. But macro comes sometimes and breaks some of those rules. And as you said, history rhymes, right? It keeps happening again and again. So what's happening now in the global space? What is your take on that and what is your take on that affecting the portfolio?
So when we're looking at quant, right, I think the rules make sense in a certain environment, right? Like I think that's something that we used to, like back when I started, I was not like aware of this fact. And then, as like I matured and as I read a lot more, I realized, okay, fine, for a backtest to work, the environment needs to remain the same.
Correct.
For example, if I run a small cap backtest 2014 to 17, great.
Yeah.
give me 35% per annum, I would say, oh, can I replicate this? But the environment is not the same again. So from a macro lens, the idea is to figure out the environment. So I think, Warren Buffett has this rule that he says that when you're giving any information, one is that there are two things, right? It should be knowable and you should be able to take action on it. Right? I think macro information is knowable, but very hard to take action on.
Yeah.
Right. So what we end up doing is that, okay, fine, we try to gather all the macro information and try to just create, okay, fine, what kind of environment we are in. Today, as we speak, we are in a really volatile environment. I've spoken about this earlier also. And I think that, US is going to go into a crisis with everything they're doing. Like, I mean, as we speak, we've seen this weekend, they took over Venezuela. And all this is happening to solve the debt problem.
It's all a subset of that, yeah.
Right, all a subset of that. So these guys are sitting on $38 trillion of debt and they need to refinance a large part of it over the next 3-4 years. There are only few ways that you can refinance it. So what they did, over the last 30, 40, 50 years is they enjoyed all that free money, printed, took on debt, and then they spent all that on unproductive assets. Right? And I would say unproductive assets like defense, taking over Iraq, and also spending on, consumption is extremely high in the US, right?
Yeah.
So all that money is spent now. Now this cycle is coming towards an end. So Ray Dalio mentions that there's an 80-90 year cycle. And you and I, Shashank, we haven't seen the dollar not being at the top, right? Like we've always seen that the dollar is the supreme currency. Yeah. But we are already at that stage, and in the last 1 year we've seen the dollar has depreciated against
and the cracks
all,
are coming out,
right? Across all major currencies other than India.
Yeah.
If you look against
that was sad,
the euro or the pound, etc., it's depreciated heavily, like maybe 15-20%. So we're already seeing that effect, and that's why they're really struggling now. So anytime we see a macro event like this, it's going to affect India for sure, right? So I don't know if it makes sense to be extremely aggressive today, right? So you want to have allocation on the small cap side, but that allocation needs to come with extremely good timing. Things need to be available at a throwaway price. People need to be fed up. And you don't need to be an ace macro investor to do this.
Yeah.
I think you will see that in your environment, right? And I think we're already starting to see some signs. As you speak to people like, I'm not interested in equity. I want to invest in the US. Nasdaq has done so well, right? Like as I speak to more people, oh, do you have a fund in the US? I don't want to invest in India anymore, right? Slowly you will start seeing exits, and that's where opportunities will pop up. Right. So from a macro lens, we do end-to-end macro analysis. We are trying to figure out where the market is. But from an investor angle, I would say, you can see those cracks on the ground level. You don't need to be a Ray Dalio to know when to do that stock picking.
Correct. Very interesting. So because this, I see a lot of people have migrated some of their portfolios to US.
Yeah.
At again, unreasonable valuations, which is going on in US right now. So you're playing the peak there and you're not playing I would not call us the low. We're still flat. I would not say we're very overvalued, but we're not very undervalued as well. But a lot of people also say that you should diversify. I remember recently that S. Naren's mutual fund investment holdings had come out, and he had invested in this FOF, which had holdings across 15-20 countries, right?
Right.
And that I think triggered a lot of people saying, oh, we should also be diversified. That only came because we didn't make money this year. Right. Nobody spoke about diversification 4 years ago. But you as a fund manager, do you think over a period of time, because the world is changing crazy right now, do you think we should have a diversification across India, or should we still just be in India?
I think it depends on what your objective is.
Okay.
Right.
Make money.
Right. If your objective is just make money, and I think at anyone doing say a sub 50 lakh portfolio, there's so much opportunity available in India. Like I said, right, there's a fund that is up 30%. The fund is managing north of 2,000 crores in the last 1 year, right? So see, all this comes with hard work. All this comes with a lot of research. If you're not going to do research, then there's a problem out there, right? I think research is necessary. You can't just read the newspaper and spend 1 hour a day and think that you're going to generate alpha. Right, then your best option is actually just give your money to a mutual fund. Yeah. Right, don't think that, okay, fine. If you're deploying money in the US, you need to understand why you're deploying money out there. Like, what's the future like? What's going to happen over the next 5 years? I don't think so. You should be deploying money out there in any way. Right, I am pretty much against that. On a large scale, that if you're thinking from a 5-6 year angle, I think they have a much larger problem than what you can see on the surface right now. Right, look at what they're doing. They took over an entire country. Right. Yeah. And without without even worrying about it. See, we're in an era where these things don't happen. And this guy, he invaded the place, took the president out and says that, and openly says, I'm going to sell the oil.
Yeah.
Right. So they're having problems.
These are Hail Marys that he's throwing around, right?
Yeah, exactly. Right. Like now the point is that someone behaves like this only when they're in a crisis, right?
Yeah.
Like, see, if you're in a great space,
you play
and
diplomatically.
why do you want to, like, look at India, right? I think, we are pretty clear that we don't want to be involved in all of these things. So we don't have a view on these things.
Yeah.
We don't have a political agenda because we are very well placed. These guys are not well placed. So I think having allocation to the US. So, I spoke about this a couple of months ago also, right? In the US, you're seeing a bull market. And that's the nature of bull market. There's a parabolic curve.
Yes.
And this can continue. You can be up 40% from here.
And then
you don't know what's the top. And don't even think that you're going to be able to time it.
Nobody can,
right?
yeah.
No one can time it. And, you can get stuck at it. And probably when you enter, it's going to be the top.
Yeah.
That's what happens with most investors, right?
Correct.
So don't think that you can time it. But right now, what you're seeing is a parabolic curve. We saw something like this back in 2008 also.
Yes.
Right? We didn't see this in 2020. We saw it in 2008 where things were going through. There's a reason why someone like a Buffett is sitting on a 40% cash.
Yeah.
Right? He's having a cost of capital. Like as the markets are moving, for him, that's an opportunity. There's an opportunity that's lost. But if someone like him is sitting on a 40% cash, you got to rethink your deployment to the US.
And he's been the biggest advocate of US as well, right? Over the history and never bet against kind of a thing.
I think, very is a factor of a lot of things. And, being born like in 1960 in America, one of the most important factor was that his entire bull run came in that era where, this president came in and said that there's no more backing of gold needed behind the currency. So we came into this era of fiat currency, where currency has no value. So, Robert Kiyosaki, like he's pretty famous, comes on TV and he speaks about, the dollar doesn't have value. But you should take him seriously. Actually, it doesn't have any value. The paisa, the rupee does not have any value. What has value is like productive assets and gold, right? Those are the only actual stores of wealth. So even equities, for example, has value. So Warren Buffett has seen that entire journey. And he's had, people don't know about this or they don't think about it as much. He's had access to capital at 0% interest rate because of the way he structured his business. So, he bought the insurance business. Geico is his insurance business.
Yeah.
And that business gives him float. And using that float, he invested in the market. So actually, if you, even if you do...
It's like LIC kind of a thing.
It's exactly like LIC, right? Like, see, his track record has been really good. I think the last 20 years, he's done as much as the S&P 500 or maybe a percentage point more. So it's not like crazy amount of outperformance. Long-term track record, probably 40, 50 years is 18, 19 or 20% per annum, which is also phenomenal. But that does not make you the richest person, on the planet. I think what made him the richest is access to a large amount of capital at 0% interest cost. That took him out there. So stock picking alone. So a lot of people, tell me that, should I just leave everything and do stock picking? I think that decision would depend on what's your starting capital.
Yeah.
If you're starting with 10 lakh,
even
if you're starting with 10 lakhs, okay? Shang, like you say, you start with 10 lakh rupees. I think most fund managers I don't know any 10-year PMS track record of more than 30%, right? That's probably the top.
Yeah.
And there's only one person out there. So assuming you are able to do that, right? You'll make 3 lakhs the first year, you'll make 4.5, right? So I'm saying that number is not going to be very significant over the next 3-4 years. But if you would spend your time and you were able to sell your time, you would probably make more than 5 to 10 lakhs that year, right? So it would make sense to actually not spend your time on investing, right? You'd rather put that money in a mutual fund. The mutual fund would have given you maybe 16-18%, and you didn't do that 30%, which is fine. Right? You had made 16-18, but you spent your time doing something else,
which put more capital into
your pocket. So I think these are the things of finance that you got to keep questioning. There is no set model. You got to keep figuring this out.
And what is your take on India now? I want to understand, where do you see India going in the next, let's say, 5 to 10 years, or maybe 10 is too long, but let's say 5 years into the future. What are some themes you are seeing are fad, and what are some themes you are seeing are inevitable, they have to play out?
I think something that's surely going to play out, and reiterating this, that you have to hold on to hard assets. What's going to happen in the US? See, 2020 to 2025, what we've seen is exceptional amount of money printing. So the US balance sheet was $4 trillion back about 3.9 in 2020 pre-COVID. 2020 towards the end, it became $7.8 trillion. So what they took 25 years to print, they printed in 3 months. That led to this crazy rally. Nifty, catered at like 24-25%. Small caps were up like 30%. I think that this might repeat. Now
this
what?
printing
The printing, the printing is surely going to happen. They've already started printing. The quantum could be really large, much larger than what we saw in 2020. So when they printed like $3.5-4 trillion, inflation went to 9%.
Correct.
That's why, cost of all assets have gone up. Same thing. So, what we saw was asset-based inflation, right? More than, price inflation, like more than consumer price inflation. What we saw was that assets started getting inflated because the rich got richer, and they were willing to pay a higher price for everything, right? So that's why asset prices went up. Right now, if I have a lot of money in my pocket, I'd say, fine, let's go buy 100 crore house. Like over the last 4-5 years, even in Mumbai, we've seen like, deals where people are buying a 300 crore house or 200 crore house. These kind of things not happened in the past.
No, and for someone who's in a salary job, right, I think homes have become slightly out of reach, right?
Absolutely.
Even I've been seeing it in Bangalore. It's just going up and up and up and up. And I have to go out of the city to live properly if I want to.
And this is a learning, right? See, that's how, like, to get out of the situation, first you have to understand the truth of the situation, right? So if you want to be rich, you have to own an asset now. You don't have an option. The US government is going to print its way out of its problem. There's no other way.
$30 trillion problem. Again, I think there's 10 trillion maturing this year or
exactly,
start
right?
of next year.
When they printed 4 trillion, inflation went to 9%. If they end up printing 8-9 trillion, like the number could be a lot higher than that. If that happens, you're going to see this asset price inflation play out again. So whether you're in India or, Venezuela or Pakistan, you don't have an option other than to own an asset. That's the only way you can hedge yourself against these things.
And this is why asset prices all over the world unilaterally went up.
Across the place. So, I've spoken about this earlier. Look at the Turkish Stock Exchange, look at the Karachi Stock Exchange, look at all these places.
They also went up.
Right? Like these guys are up like, 10x, 20x. I'm not even talking about percentage numbers, like 10x, 8x, 12x over the last 10-12 years. All thanks to a lot of printing that's been happening. We're going to see this on a much larger scale. See, these countries are really small, like Turkey and Karachi. All these places don't affect the world in any way. Them printing does not make a difference even to their neighbor. But when the US is going to do that, it affects the entire world. Right. So my view is that, you have to hold on to an asset, right? You can't blindly buy an asset, but, you make sure that, you start deploying capital soon, because, you might see this time drawdown and then, you might see asset prices move up.
Yeah, but assets will come back to reality at one point and then again.
I don't think so. Assets will come back to reality at any point now. So don't expect house prices to fall, or don't expect, there's a big gap between, like, when we talk about real estate also, right? Like, it's something that really interests me. Places like Mumbai, Bangalore, Delhi, etc. New buildings, like new construction, for example, in a place like South Mumbai, cost you 90,000. If you're going to buy a house, 90,000, 80,000, 70,000 at least per square feet. Next door, there'll be an old building which will not even sell for 30,000 rupees. Right. So why is this gap there? Is because, see, the builder who's making it, his cost of construction has gone up significantly. He can't make that house in 30,000 anymore, right? And the house is now a depreciating asset for the old building. You're seeing cracks. Young guys don't want to go into that house, right? So the asset price has gone up. Now he can't sell it for less than 60,000. He doesn't have an option, because that's the cost of making the building, right? Because raw material prices have gone up. So don't expect that, like when a new building comes up, you're going to get it at 40,000. You're not going to get it at that price anymore. So, expectation that assets are going to fall is a very bad idea.
So assets go up, then you will also see a commodity cycle coming in along with this, that commodities related to raw materials should also start doing well.
Absolutely. So this printing is the cause of everything. If you're able to understand this, it's as simple as that. So this is what Buffett understood back in 1960. That listen, this is paper. This does not have any value, right? What has value is productive assets, because these guys will keep printing and the value of this is going to diminish. So the only way to play myself out of this is remain invested.
So as an investor, how do I play this?
As an investor,
where do I play it?
You don't hold FDs. Correct. You invest equities.
And in equities, how do I play this?
Within equities, you hold, today you start holding businesses with their underlying commodities. There are underlying assets. You're not doing inflated valuations where cash flows are really strong, right? So personally, when I'm looking at any business today, I'm not looking at a story anymore.
Okay.
Right? Like 2022, 23, there were a lot of story plays.
Theme
plays that, in 5 years, these are going to be the numbers. I don't think there is room for that anymore. There will be some outliers, but I think the big play will be businesses which have like underlying assets, businesses which already have a certain cash flow with strong balance sheets. You want to just back those things. I think then you figure out what what can you understand, right? For example, like I really like a broking business because I understand that business, and like they're throwing maybe 800,000 crores in terms of cash every year, really cheap in terms of valuation, right? I want to be a holder of a business like this. Even if I can go wrong, I'll be down 15%. I'm very comfortable holding this for the next 10 years. I completely understand that, like a broking or an AMC business it'll continue doing well because asset prices will go up, so the underlying holdings will continue rising. Right, so you want to capture those kind of businesses.
So proxy to asset prices going up will also play out very well.
Absolutely, it's going to happen. It's not 2030. It's inevitable. That's because it's scientific. It's not even
Beautiful. It's math basically.
Yeah, it's math, right? So see, I don't want to say anything with that kind of certainty because things can change in the world. But I think like if we had to take a bet, then the bet would be that.
No, there would be definitely one printing cycle.
Yeah,
definitely. Before the whole thing, I don't know when that will happen. I feel we are on track to a very big, changing of the world. I think Ray Dalio talks about this.
Changing
right?
world order. See, he's not timing the market in any way. If you look at his own portfolio allocation, if you look at what he says about, because most people are trying to read the book and understand, is he telling me it's going to happen in December? Is it going to happen in March? Is it going to happen? I think he's not giving any signals, and even he doesn't know.
He's talking about a concept that it happens, usually the world order changes.
Like it could happen in 26, in 27, 28. We don't know when it will happen. Yeah. But, I think what's going to happen is that asset price inflation will come through. So as an investor, your play is pretty simple. You have to continue remaining invested. You don't stop your SIPs. You continue putting in money. If you're doing stock picking, then look at strong balance sheet businesses.
But don't you think there is one big problem that is being faced right now with asset in India, right? Asset prices have gone through the roof. Yes, interest rates have come down. Most people are on this EMI track right now, and salaries have not adjusted to the price of inflation, right? Or price of anything, because our currency is also taken a beating this year. Is there a nice squeeze that we're seeing right now? Even if I'm invested or not, I can't put the initial capital which I used to put before.
Absolutely. Like this squeeze is really large. In India, we are seeing it. In the US, it's at another extreme. So what's happening in the US, right? So this is a part of the cycle. As the gap between the rich and the poor keeps increasing, there'll be a lot of social conflict.
Domestic.
Right. So ultimately like the guy who's suffering is the salaried man.
Yes.
Right? Because his salary is not increasing at the same rate that an asset price is increasing. Now, what's happening because of that is that all the salary that's coming in is just going for survival, which is rent and food. Right, that's it. You don't have any discretionary spending. You don't have any savings for mutual fund investing or any of those things, right? And that's where I think like the salary is a very big trap, right? I mean, you yourself, Shashank, you moved out of a job to doing your own business, right? I moved out of my job to do my own business. I think like Robert Kiyosaki is the only guy who vocally speaks about this, and says that listen, the US and like a salary job is making you sort of paralyzed or is not putting you in the right space unless the firm that you're at is thinking about you, right? And thinking about your growth, right? I think like there are exceptions. I will not say that like it's a flat structure and everyone is bad, but I would say that you have to think for yourself. That what's going to happen to me 5 years down the line, because asset prices are going to go up. If you think that your salary is not going to, go up by 4 times, then there's a problem out there, right? So I think that what you're talking about is a real problem. And, you have to think about it. Ultimately, like, I think financial literacy is something that, like, you got to keep, even at my stage, right? I'm learning so many new concepts, right? For example, like, I was thinking of, like, I'm 32 today, and I was thinking of a house over the last 2-3 years, right? And I realized, like, my house is not my asset.
Yeah, it's a liability.
Only when you think of these things deeply do you actually start realizing, okay, fine. Because until you don't think of the problem, until it's not on your plate, you're right, you don't care of anyone's view. Yeah, house is an asset, not an asset doesn't matter because I don't need it today. But the day you need it, you'll start thinking of.
I had this problem 3 years, even I'm 32. So 3 years ago, I thought, okay, let's get a house, because when you're married, you want
a house, yeah.
And then the asset prices started flying. So I felt like I was playing the catch-up game for 3 years. Now I'm like, what, screw it. Let me just build cash flow. So now my whole mind is cash flow versus asset liability.
Absolutely, right? Like I started looking up, okay, fine, what would Warren Buffett do in a situation like this? And it's great that you can start using AI for these things, right? You put down who your mentors are, and then you start asking the engine that, okay, fine, what would this guy do in a situation like this? And then they actually, I found some research where Buffett had a speech where someone asked him that, what is the right time to buy a house? And he said that if the down payment is less than 10% of your net worth, then you can buy the house.
Down payment is 10%, less than 10% of
If the down payment is less than 10% of the net worth, then he gave an example. He's like, I got married. I think he got married at like 24. And he said that my wife, my to-be wife, then she said that, should we buy a house? So he said that, see, the raw material that I have is money. Okay. And I don't mind buying my house today, but let me wait for 5 years and, we'll probably buy a better house because I can put my money in the house today, but I won't have any of this raw material left.
Correct.
So if you look at the thought process of the guy, right, he's looking at money as a raw material. We don't even think of money as a raw material. Like we are so protective about our money, my money in my bank and like, my assets, right? Saying this is just a tool, a means to get to somewhere. So the thought process is that, okay, fine, I need this raw material to get to somewhere. Because had he put that money in his house, finished, he wouldn't be where he is today.
Then catch up game for 5 years to come back to starting point.
Right? Like I don't think he would be Warren Buffett.
Yeah.
Right? So correct. I think that decision and like thinking of these things, objectively is so crucial.
But do you think people now are becoming like that in India? People are becoming smarter. There are debates across house versus not house and all of that. House versus cash flow versus house versus living. So
it makes sense to buy a house, right? Like I'm saying, you have 100 crores, go buy a 8, 9, 10 crore house. No problem, right? Like if the down, like he said, if the down payment is less than 10%, if that's less than 10% of net worth, fair, because now you have enough of raw material.
Yeah.
Right?
Yeah.
We keep seeing that in the Nikhil Kamath thing that, house. See, it doesn't matter. At that scale, it absolutely doesn't matter. It's no more a financial decision.
Yeah.
It's just a matter of I want it. Just from a convenience perspective. There is an emotional aspect to it. There's a convenience aspect to it. There are lots of things.
Yeah.
Right? But when you're 25, 28, 30, even 35, right? What you're thinking of is that, okay, how does that change? And I think delayed gratification is important, right?
And one last question I have on this. What is your take on FIIs? Because you're also a fund manager. I'm sure. I mean, when FIIs come into India, it's technically a good for everyone, right? When they leave, it's a bad for everyone. Even though we can play it out and say that DIs are stronger and all of that, having foreign currency coming into our country is always a positive. Now, obviously, the net outflow has been higher. But what do you think about this? When do you see this? Do you guys have this some kind of a tracking mechanism, or even from your viewpoint understanding? What do you think about FIIs? When will they come back to attractive India again?
I think they play like a large part as an interest rate cycle. And like, see, if in the US you're getting a 5% yield on a dollar bond, I think, they would take that hands down, right? Which is what's happening, right? We've seen like post 2022 or 2021 interest rates were at 0 and they've gone to 4.95% today. So at a 5% interest rate cycle, no one wants to keep money in India because you're seeing that 3% depreciation in the currency, 6-7% in the last 1 year, right? Yeah. So technically they ended up making 10-11% against the rupee, 5% on the FD out there on the bond, and then 5-6% in terms of their currency appreciation against the INR. So they ended up making 10-11% without doing much. The only time you come back over here is when you actually start seeing earnings growth, right? We've seen earnings slow down over the last 1 year, right? So until and unless the economy does not pick up and we don't see that earnings growth, I don't think they're coming back.
And the earnings growth has to be over and above your currency depreciation as well, because even if I get a, let's say 12% earnings growth, stock goes up by 15, but my currency is falling by 10 or even 7-8%. So, and plus taxes net 10%. I'm not going to be very happy to come here, right?
If you look at the Nifty, right, like long-term 20-30 returns like 11.5%. The way I break that down is 7% is inflation, 3% is currency depreciation, only 1.5% is actually corporate alpha of the 50 businesses that are there under the Nifty 50, right? So just doing 10-11%, you're just making the cut. If you're making 10-11% as an investor, you're just making the cut. You have to figure out a way on a personal level that, how do you optimize for your cash flows and your CAGR. See, after a certain point, that 11-12%, even if you grow money at that, will be fine. But to get that, to get to that point, say for example, I end up spending 50 lakh rupees per annum, right, on living in Bombay, or maybe 1 crore per annum, because Bombay is an expensive city. If I want to spend, purely from my income, that means that I need to have, say, a 10 crore corpus, right? To have that 10 crore corpus, then I'm making 11%. Now I'm just maintaining my capital. I'm not even beating inflation, because this 10 crores after 10 years will be worthless. So now every year I'm just spending everything I have. So I can't grow my money at 10-12%. I have to figure out a way to put maybe 3 or 3.5 crores in my pocket. Right? I can't look at the situation that, oh, I'm making 1 crore, I can spend 1 crore. Right? And I don't believe in the concept of reducing your expenses. I don't think so. That takes you anywhere, like after a point, like, how much will you cut? I'm not saying you go buy a Lamborghini, but you would buy a car, you would have a house, you would have expenses, right? How much will you cut down? Right? I think there are better ways of, the upside is unlimited.
Yeah.
So from that perspective, I think so that the inflation that we are looking at is 10-11%, especially like asset price inflation, etc. It could be even north of that. So you have to figure out a way to beat that significantly.
Yeah, I think next few years should be a little hard, the way I see it.
I think it's going to be hard. It's going to be great.
Right, you can win.
But it's going to be great for guys who own assets. See, it's going to be really good because then that's like, there's a video of Warren Buffett where, a journalist is asking him, this was last year, this year, 2025, when Trump was announcing the tariffs, etc. And she was asking him, in an economy like this, who is winning? And he says, people like me, You would think that that's so arrogant, right? But he's just being truthful about it. He's saying guys like me who own assets. So in America, I think around 90% of the assets are owned by the top 1.5%. That gap is really large. And the bottom 50% own less than 2% of the assets.
Oh, is that why Trump is now talking about ensuring that institutions cannot buy assets anymore? Is it because that whole cost of inflation is coming into that? There's recent rule that
no, I don't think so. Like, I think like they are a pretty capitalist economy.
Yeah.
Like they are pretty much like, we want to just make money.
Yeah.
And like the guys who make money win. Yeah. Their economy is very different from us. Like we are more towards the socialist wherein we're talking about the mass in general. Out there, the government is run by the rich.
Yeah, true.
Right. So
true.
I think like I don't know the exact situation, but I don't think so. They would
pass this.
Looking at
Because BlackRock gets affected.
Yeah. So I don't think so. They'll look at that. But there is a social unrest right now where people like the situation that you mentioned, Shashank, that people are not able to even bear their daily food expenses, skipping meals for that in the US. Right. Sitting in India, you wouldn't think that something like this would happen in the US. I know people who are not able to meet their meals. Like they aren't able to take one meal in the day because it's becoming costly in the US. A $2, like if you ever travel to New York, a $2 Starbucks is like, 5-6 years ago was costing you $7.5, $8 today, which is insane, right? Like you're paying $8 for a coffee. So, and Starbucks is supposed to be like a chai wala in India.
Go-to wala.
Right? Like, everyone's having a Starbucks. There's nothing below that out there.
Yeah. Awesome. And one last thing for the audience, right? Some books or newsletters or reading, where do you go and get your knowledge from? Something that they can also start doing.
I think what I end up doing is that I end up buying 10, 15, 20 books together. And then I just like keeping up something I like. If I don't like it, I just leave it.
And something really recently hit you well? Like a book that you really like?
Recently I was reading all on Ray Dalio. So, and the reason I was doing that today is that, I wanted to understand where the world is going. So his last book is called How Countries Go Broke. And the book is red. Like the entire book is red. And he's screaming that, listen, the US is going to go broke. I'm writing this down. Like, see, the guy is managing $200 billion. And, he like takes part in discussions with the Fed and the US government. And, he's probably like an insider. And the insider is telling you that my government is going broke. And if you aren't listening to him, there's a problem. Right? Yeah. Because that's going to have implications. So that's something that, I've been actively reading. Apart from that, I end up doing a lot of I read a lot of the stock picking books. I recently read a book written by the late Parag Parikh. And he wrote this book on value investing back in 2006 or 7. And it's pretty interesting about
Still holds true.
Yeah, like absolutely, right? And like he did this really cool backtest that we recently backtested that, and anyone could also try this out. Where within the Nifty 50, he ranked businesses based on, so his backtest from 98 to 2006, because that's when he wrote the book. And 97 to 2006, I think it was like a 9-year backtest. And what he did was that he ranked all the businesses based on price to earnings. So the lower, the better. You want to buy the cheaper business, right? And he bought instead of buying the Nifty 50, he bought the top 20 businesses.
Which is the lowest PE businesses.
The lowest PE businesses. Because that's the concept of value investing, right?
Correct.
You want to buy the cheapest, high quality business, right? So he bought those 20 businesses and then once a year he would keep rebalancing that. And then that versus the other 30 businesses, how that performed. And there was a significant, difference in the performance. The low PE businesses end up doing extremely well, What was also cool was that how it performed year after year. So within the book, he's actually drawn the table, and he did it on the Sensex. Nifty was not there back then. I think 96 Sensex was the first exchange. So 96, 7, 8, I think 7, 8, 9. The 3 years where the tech bubble was there, right? So all the high PE businesses did extremely well. So those 3 years, the expensive businesses were doing like 50%, 40%, 70% per annum. And this, low PE business was like a 10, 20, 12. So significant underperformance for 3 years and significant amount. Then 2000, these were down like 65% and this was up 12%. That 1 year, what we spoke of even earlier, right? This 1 year created that big outperformance. And then we extended this backtest up until like 2025. And we saw that if you did this, the low PE businesses gave 16% per annum versus the Nifty that gave 12 and the high PE gave like 9. So, I was like, see, the thing is you got to keep scouting for ideas.
Yeah, that's actually
right.
Cool,
like it's, you can actually try this out and it makes sense. It works better than the Nifty.
Yeah.
And what's important to see in the backtest is see how it performs in different time periods. Because there will be years where you will underperform.
Yeah.
And then there will be years like this where you will outperform.
Yeah.
Like this year, you will see a large outperformance out there.
Yeah. Now that they just recently announced the large cap fund also. So who knows if they tweak something like this even more. Yeah, very interesting. But awesome, Rishabh. I think this was super because I think we spoke a lot about a lot of things. We started with quant, went to small cap, value, went to India, went to the world, and we have given, I think, a lot of information.
Yeah.
But again, Rishabh, thanks a lot for giving your knowledge because I think for someone who's watching this, you get a very good overall sense of things, right? And what really hit me in this entire episode was the fact that yes, it is going to have a printing cycle again, and asset prices are going to have the second run of inflation anytime soon. So how do you build your portfolio ready for that? So again, amazing learnings, man.
Absolutely. Yeah. Thanks, Shashank. Thanks for having me.
Thanks a lot.
Yeah, perfect.